All right, let's get started. I put y'all's grades out there. I do have comments. I've made comments as I went. Unfortunately, it's in Excel, and I need to check typos and that kind of thing. So it may take, and boy, I've been in Zoom meetings almost constantly the last few days. So I'll try to get to them. My guess is you're probably going to get started on papers 3 and 4. So it's up to you. If you had minor issues and you want to just fix it now and turn it back in, just make sure if you resubmit your paper, make absolutely sure you highlight anything you change, because I will not regrade it if it's not highlighted. There's no way I'm going to regrade your paper in total, because it takes me, boy, I was grading 10 papers a day, and that still takes me a long time. So it's time consuming grading these. So you have to just do me a favor. You can call me and ask me questions on that. So there's one side to resubmit it immediately because you're thinking about it, it's on your mind. The other is you can save it to the end and see what your grade is and see if it makes much difference, kind of thing. But then it's gonna be old and you won't remember it, so you have to decide. There will come a point if you turn it in late that you miss the deadline for being able to resubmit. So if you get too late, I'll let y'all know when that is. I'd definitely be before papers 3, 4, and 5 are due. So in fact, it might be, because I can't be grading a whole bunch of papers all at once. So if you're late on your first 2 papers, there comes a point where you're so late you don't get the right to resubmit, which can be a pretty important right. So anyway, but I'll try to get y'all comments back here hopefully this week. I've got 60 something papers graded this weekend, so I got to get it done before then. All right, so what I want to do is we're going to talk paper 4. I think an extremely important paper. What I want to do first is just show you the rubric for it. I put the rubric out there. And now it's not on my, I know it's out there, paper 4 rubric. I don't know why it is when I try to share, I don't see all the files. Show all, yeah, it just for some reason doesn't show all of them. So, all right. So this is the rubric. Let me walk you first through the rubric so you understand. So this paper is very straightforward. I want you to do exactly, and not only that, but I've already written an example for it that you can just edit it. So you want to make sure on this paper that you start with the Walmart example. It gets a little tough because it's a different file and a different format. So you may have to copy and paste into your format so it gets all integrated together. But the format we're going to use, we're going to do a short-term look. So up through line 10. You want to make sure the firm is solvent, viable. Then we're going to look at growth, and we're going to have a summary of growth in line 19. Then we'll look at return on equity, and then we have other analysis. Liquidity, I'm looking for 3 things. Solvency, I'm looking for 4 things. Then you have your summary. Turnover, I'm looking for 3 things. Margin, I'm looking for 3 things. On ROE, I'll walk you through exactly how I want you to do ROE. Other analysis, I'll give you some ideas. That's only 7% of the paper. On this paper, I usually have it's 40% coverage, 40% clarity, 20% critical thinking. This paper is not. This is the rubric. This is 100% of the rubric. So I grade clarity and critical thinking, since you're essentially copying my Walmart anyway. Those don't really count. So this will be the grade. So we're going to walk through each one of these. The hardest ones are liquidity, and by far the hardest is net working capital requirement. That's the toughest. After that, the capacity is a harder one. It's not horrible, but I think it's an actually really, really critical one. For some reason, students don't like this one on the revenue to the bottom line. I like it a lot. We use it at UTSA, and I'll show you how we use it at UTSA. Actually, they restructured the entire company based on that chart. So I think that's pretty important. And then the ROE, some students have trouble on that. Some people struggle with the ROE as much as they do with the net working capital requirement. And that's because you have to have 4 things you're looking at once and trying to decide what's really driving ROE. If you've done any kind of ROE decomposition, you see where I'm going. I do it differently than what you got in your accounting classes, so you'll have to do it a different way. But liquidity is by far the hardest, mainly because We don't do it the same in finance as they do in an accounting, so I have to somehow clear your mind of what you learned in your accounting class, because we just don't do that in finance at all. So that's going to be that's a tough one for that reason. So this is your rubric. You want to follow this extremely closely. Make sure you do every single one of these. And if there's one of them on here you don't know how to do, then talk to me. But every single one of these is in the Walmart example, with the exception of other analysis. And I'll give you some. I mean, some good examples of other analysis can be like inventory turn, or receivable turn, or EVA, or return on invested capital. There's a few that I built for you that you can do other analysis out there that you have the charts for. The reason I don't require those is because not every company has an inventory turn or receivables turn, or all firms have an EVA, but I left that out. So I left out a few so you can shop around and see if there's a ratio that really works for your company that you can add into the analysis. All right. Now y'all interrupt me with questions as we go, because this is going to be a really critical analysis. So what I'm going to do is I'm going to bring up the class notes, and we'll walk through the class notes first, and then I'm going to do the class notes for liquidity, and then do Walmart for liquidity, so that we have it, you know, we see the data and then we see how it's actually interpreted. So let me share the screen again. If I can find it. There it is. All right. So here's the model we're using. And we're going to do number 1, A and B, number 2, A, B, and C. We won't do 3 in this paper. We're going to do 3 in paper 8. We're going to be using CAGRs. I'm hoping you remember how to do a CAGR. We'll look at that ratio. So let's start with liquidity. So the key for liquidity is the operating cycle. And you need to think hard about your company and its operating cycle. So let's walk through the typical operating cycle. This is kind of the value chain analysis. So let's think about a typical kind of retail store. They first of all, they buy their inputs. So it could be they buy finished goods like a Walmart or Target, or maybe they're a Nike, they buy material like cotton or rubber. Maybe they have raw materials, but they're going to buy something and it's going to go into inventory. That's usually a cash outflow, but not necessarily, because they could buy that stuff on credit. But let's say they buy their raw materials or they buy their inventory with cash. So they have a cash outflow. So now they're short of cash. And then they store all that inventory in the warehouse. So that's a cash outflow, because they got to pay for the electricity, the workers in the warehouse. They got a whole inventory system. That's a cash outflow. That costs them money. And then they move that merchandise to the store and they sell the merchandise, but they sell it for credit. They sell it on credit. So there's no cash flow there at all. All they get is an IOU. And then a few days later, a few weeks later, they collect on their IOUs and they have a cash flow. That's the operating cycle. From the first point where they get what they sell to the last point where they sell and they actually receive the cash from the customers. That's the operating cycle. The normal operating cycle is a net negative cash outflow. So your question is, how much cash does our operating cycle eat up? And how long is the operating cycle? I'll show you. I built you a chart in the Excel spreadsheet that actually does the operating cycle. Doesn't work for all of your companies, especially if you're more service oriented. Doesn't quite work. But that's the normal flow. So what you're trying to do is, if you have one of those firms that has an outflow for its operating cycle, your goal is to shorten that cycle as much as you can. So a good example is when you buy your raw materials and your inventory, rather than a cash outflow, you can instead do an accounts payable. And then there's no cash flow. That'd be perfect, right? You buy what you're going to sell for on credit. So then you got to pay your creditors. What if you pay your accounts payable? What if you do that after you collect from your customers? then your operating cycle is actually a source of cash. It actually creates that cash. That's like the ultimate model. I'm going to show you here in a little bit. I'm going to show you an example of two firms that have this model, and it is the central part of their entire model. Some of you are doing Costco. I think Costco might have this model where their operations actually generate cash. Samir, I'm always picking on Samir, but Delta, amazingly, Delta has one of these models. If you think about Delta, when does Delta get your money? So you buy plane tickets, what, 9 months in advance? They get your money today, right? Do they have an unearned revenue? That's pretty wonderful. Instead of having accounts receivable, they have unearned revenue. You pay them 9 months in advance. They got all this cash. They don't have to do anything for you for 9 months. And then when the 9 months is up, they got to pay their pilots. They got to buy jet fuel and all that kind of stuff. But yeah, even a firm like Delta, which you might think, wow, that's old school. That's got to be cash outflow, but it's actually a cash inflow. So not all firms have their operating cycle as a use of cash. The normal is that it's a use of cash, but there are firms where it is a source of cash. And so I'm going to show you. So how do you do it? It's actually really, really simple. Remember in your accounting class, they talked about working capital. We don't use that term the way the accountants do. Working capital is all your current assets minus all your current liabilities. And what did the accountants say? They say they want that number as high as possible. That's when you're liquid. Finance is the exact opposite. We want that number as low as possible. But you notice I have a word added here on the end. Working capital requirement. When you see working capital, it's all your current assets, current liabilities. When you see working capital requirement, we're not including all the current assets, all the current liabilities. We're only including the operating current assets and operating current liabilities, which means our current assets include cash, but net working capital assets does not include cash. The net working capital requirement does not include cash. Cash is not an operating cycle asset. It's the result of the operating cycle, but it's not actually part of the operating cycle. So what's part of the operating cycle? Accounts receivable, inventory, and any prepaid expenses like paying rent in advance. Those are your working capital assets that are directly tied to this operating cycle. The other thing net working capital requirements doesn't include that working capital does is short-term debt. Short-term debt is not an operating asset. It's not tied to your operating cycle. It's outside of it, and it funds that cycle. So you notice the working capital liabilities are only accounts payable and your accrued expenses. So there's no cash in the assets, and there's no short-term debt in the liabilities. And that's what the net working capital requirement is. All right? Everybody get that? It's a pretty important concept. Not just for this class, but just understanding. I was listening to I've heard several podcasts where finance people were saying, wow, this firm is extremely well managed. Their working capital is negative. Most accountants would hear that and they say, what in the world are you talking about? Negative working capital? That's a firm about to go insolvent. They're really illiquid. But finance says, no, you don't understand. Accounts receivable are horrible things. I'd much rather have the cash customer than have an accounts receivable. So if my customers owe me $1 million, I want them to pay me as soon as possible. I don't want to go around bragging that people owe me money. I want them to pay me. Inventory. I'd much rather have my inventory show up 2 minutes before the person buys it than have it sitting there for 9 months while I'm waiting to sell it, while it's sitting in the warehouse getting obsolete and all those kind of things. Now,
Professor,
I'm sorry?
Wouldn't that be the way Toyota does it? They do things like up to the within the day inventory.
Yeah, just-in-time inventory. So the downside of, obviously, talking your management class, the downside of that is you're out of stock. You have something like COVID-19, or with Toyota, we had the Japan earthquake, and Japan was the source for a lot of parts for cars, and essentially the car industry shut down. So there's a downside to managing this really, really well, because you have some kind of crisis. Now you don't have anything to sell. But yeah, exactly. Just-in-time inventory. The auto manufacturers are really good at this. I don't know how good Tesla is at it. I haven't looked at their numbers. But we don't want a lot of inventory. We'd rather be as low as possible. We want to manage that extremely well. Accounts payable, that's essentially free debt. I mean, yeah, they may start charging you interest after 30 days or something, but you want to extend that as long as you possibly can. I remember I had to do accounts payable at UTSA, and we had a bank. We used Bankers Trust, and we wrote in our contract that I didn't have to pay them if there was any errors in the bill, and there was always errors in the bill. I had some bills that we owed them $300,000, $400,000, and it would be wrong for 9, 10, 11 months. I mean, it was just amazing, and I wouldn't pay them. Sometimes it was a 2-cent error. 2 cents times 100 items. So 20, or, $2 or something, just really small. And I'd say, no, you told us you were going to charge this. And I would hope the bill, and I called this guy, and he would cuss every time I called him. And he wasn't mad at me. He was mad at the billing people. But yeah, you try to milk that as much as possible. And I always ask students, if you could borrow money at 0 interest, how much would you borrow? I would borrow $77 trillion and invest it in T-bills and make a fortune, right? If you can borrow money at 0, you do it. Accrued expenses. At UTSA, I worked 2 weeks, and UTSA would pay me a week later. So essentially, they owed me money for 3 weeks. They didn't pay me interest on that. That was an interest-free loan. Now, should they change it and say, hey, we're going to pay you every 6 weeks? No, because then they lose employees. But that's a good thing for them. They don't have to pay me. They don't have to pay me every single day I work. They pay me 3 weeks after I work the first day, and 2 weeks and 4 days after work the second day. So they've got my money. They haven't paid me, and they get to keep that money interest free. So these are, I know the accountants say the exact opposite, but these are wonderful things. Accounts payable, accrued expenses is like borrowing money for free. These assets are terrible things. Accounts receivable, that's when people owe you money and they're not paying you interest. That's inventory sitting around and doing nothing. Prepaid expenses, you're paying people in advance and you don't earn anything. I should have put on here, and we probably should for airlines. Shamir, I'm putting this on for you. Unearned revenue. Y'all remember that from your accounting class? Joseph was talking last time about the accounting classes and how finance majors can really hate getting into some of those details because it gets some minutia. But
sir,
you have to know this stuff. So an unearned revenue is when your customer pays you in advance. The exact opposite of prepaid expense.
Professor.
Uh-huh.
Isn't that also sometimes referred to as deferred?
You can have deferred revenue. Now, I come from the insurance world, so when you say deferred, it means something really specific in insurance. So I'm a little touchy with that word.
Okay.
There might be some industries where deferred revenue and unearned revenue mean the same thing. In insurance, it doesn't. In insurance, it means something very, very specific. So yeah, there's industries that have their own terms. But Samir, I don't know, Samir, you might look. I don't know if Samir's on the call, but if he's on the call, you might look for Delta and see if they have a huge unearned revenue account. And that would be a good thing, right? Don't you think Delta and Southwest Airlines love getting your airplane ticket money 9 months before you fly out? And it's a wonderful thing. So I should have added that one, but that's another one.
Well, I know on deferred revenue on the liability side of my HOA balance sheet, that's prepays.
Yeah. And those are wonderful things. Yeah, that's
Yeah.
what I worked with a school that, the parents would pay all this stuff up front, and that was wonderful for us. It was, it's just, half our rent revenue will all come in on the first day of the year. So it's wonderful. It's wonderful to have those liabilities. It's horrible to have those assets, and the accountants say the exact opposite. So we have to break that way of thinking. And I promise you, that's the way finance thinks. So I'm not giving you some Professor Sweet off the wall kind of thing. This is the way finance. That's why I mentioned that podcast. Finance people are saying, hey, this firm has negative working capital requirements. That's a good thing. Their accounts receivable and inventories are less than their accounts payable. Finance says that's wonderful. So cash and short-term are generally used to manage this requirement. Cash and short-term debt, I'm sorry. So if you have excess of this, you kind of hold it in cash. If you have a deficit, you got to borrow money to fill in the gaps. So if you're buying your inventory up front, then you have to borrow money so you can buy your inventory. It sits there until you sell it and collect from your customers. You use debt. Older companies, this can be a source. And just like what Joseph was talking about, just-in-time inventory, firms like that can actually ruin your operating cycle. There are some firms, some really amazing firms. You'd be shocked. I just mentioned Delta, But there's others like Boeing that have these negative working capital requirements. And so it's just the way their billing process works and how their expenses works and how they work with, Boeing uses a lot of subcontractors and they probably delay paying them as much as they can. So now working capital can be, if it's a use of cash, if it's seasonal, it's a seasonal use of cash, then you match it up with short-term debt and cash. If it's more permanent, one thing we say in finance is you do not want to fund a permanent use of cash with short-term debt. So if you have a permanent use of working capital, so you're just always, you're always $20 million out, you want to use long-term debt and equity to fund that. So we only, in finance, we only use short-term debt for short-term specific reasons, like a Walmart or Costco having heavy sales in December because of the holiday season. You can use short-term debt to fund that working capital deficit, although they may not have one even then. Otherwise, you use long-term financing. That's called the matching concept. So we're not going to get in that much with your firms, but if your firm suddenly sees a large jump in short-term debt, you always want to ask why that's the case. When I was a security analyst early on, I didn't know what I was doing, but I'd worked a lot with insurance, so I understood the matching concept. And we had a bunch of real estate companies come in, REOCs and REITs. And the one thing I noticed was the heavy use of short-term debt. And so I'm sitting in this meeting with all my peers and I'm the new guy. And so I have one chance to ask a question and not make a fool of myself. And as my question is, why in the world are you guys using short-term debt? You got these long-term leases on your buildings. Why would you fund that with short-term debt? And boy, it ended up being the perfect question. I was like, I'm not saying another thing the rest of this meeting. My first question hit and I really put them on the spot and they were like, well, we're working on that. We know that's a problem. And so, yeah, you don't want to use the short-term debt except for short-term reasons. Why? Because you experience funding risk. If you're constantly rolling over short-term debt and you hit a market like 2008 where the markets just freeze, you're going out of business. That's what happened to Lehman Brothers. You also have interest rate risk. When you use a lot of short-term debt, your interest expense is going to float up and down with interest rates. Otherwise, rather than using longer term debt where you can fix in the rate and your interest becomes very stable. So just that's something to think about. We won't get into it too much. So how does your firm manage that? Well, you manage your receivables, inventories, and your payables. So if your firm says they're buying a new inventory process or something along those lines, you manage it there. There's definitely industry influences here. Firms that are growing fast will tend to have heavy buildups and receivables and inventory. I remember I was working with one small firm who was doing extremely well. They were selling this new software, extremely effective software. It was just selling like gangbusters. The problem is their contract says the client does not have to pay us until we perfect the software. And what they discovered is these salespeople that were on commission, they were out there selling, but no one was going back and fixing the minor errors with the software. And so the CFO said, we're going out of business. I have no one's paying me any. You salespeople need to stop selling and you need to go back to your customers and fix their problems because I need their money. So firms that are growing fast can sometimes have serious working capital requirement problems just because they have to build with inventory really fast in advance. So let's think about the accounting approach. So here's the accountants. Here's what the accountants say. And if you're taking an accounting class, Joseph, you're in there now, or whoever's in those classes, you should challenge them on this. They say net working capital. Notice the word requirement is not there. Net working capital is current assets minus current liabilities. And they have the current ratio. I hate the current ratio. I've never seen the current ratio in finance. I've only seen it in accounting. But it's current assets over current liabilities. And what did the accountants say? You need that number to be greater than 1 or the firm's illiquid. All right, that's the traditional approach. So let me show you some companies here. So let's look at Walmart, let's look at Dell. So the current assets for Walmart are $62 billion. The current liabilities for Walmart are $78 billion. Their current ratio is 0.79. What do your accounting classes say? This firm's illiquid, they're about to go out of business. All right, let's look at Dell. Dell's current assets, $7 billion, current liabilities, $52 billion, illiquid. Now, why do I not like the current ratio? Well, Number one, Walmart and Dell are extremely liquid companies. And so the ratio is telling me the opposite. The second reason I don't like this ratio is why are Walmart and Dell so liquid? They're so liquid because this ratio is less than 1. It's not that this ratio is good, but it just doesn't work for them. No, this ratio is actually incorrect. It's measuring the wrong things. So why is Walmart's ratio low? It's because their inventories are only 44 billion, but their payables and accrueds are 63 billion. That is because they have negative net working capital requirement. Here's their net working capital requirement. It's actually negative $10 billion. Why is it? Because their working capital assets are less than the working capital liabilities. Now, working capital assets, you notice, is current assets minus cash. And their working capital liabilities are they're essentially just their accounts payable and accrued expenses. It could include some of these other current liabilities, but I left them out because of deferred tax. And so that's the story we have here. These are two very, very liquid firms, and my approach to doing this, the way finance does it, gives you the right answer. Walmart is very liquid because they manage their inventories to a very low level. They're very good at managing that. If you think about Dell, Dell's changing a little bit, but tradition for Dell selling these desktop computers is they don't build a computer until you order it. That may be true for other things they do as well. They don't have huge inventory sitting there. You come on and you specifically order exactly what you want, and they build it at that point. And so their inventory, look how low their inventories are, especially compared to Walmart. You look at inventories versus their total current assets. So it's the way to think about it. So if you're in a class, an accounting class, and they're talking about the current ratio, print this out. I didn't give this to you. You have to build it yourself or ask me and I'll send it to you. But take this with you and show it to the professor and say, why do Walmart and Dell have current ratios less than 1 when we know they're two of the most liquid firms in the industry? All right. Don't tell them Professor Sweet gave me this. I don't want to get in trouble with the PhD professors, but it's a good, legitimate question to ask the accounting professors. I wish I knew about this when I was in accounting, because it just seemed, oh, current ratio, yeah, well, that looks good. What is wrong with this ratio? Well, it assumes the only thing you have to pay your current liabilities with are current assets, and that's absolutely not true. Walmart has cash from operations. They can pay their bills through cash from operations. They get a lot of cash throughout the month where there is no inventory, no receivable. The inventory came in during the month, it was sold during the month, they collected it during the month, they pay their vendors during the month. You know, the entire thing happened within the same month. That's a lot of cash. You have more things to pay your current liabilities with other than just current assets. So I don't like the current ratio. The quick ratio just as bad. The acid test ratio. Now, why do I bring this up and harp on it? Because almost 100% of the time in the past, when I asked the financial major to do a financial analysis of the company, the first thing they did, and a lot of students, the only thing they did was the current ratio. It was like the only thing they learned from their accounting class. It was the one thing I wish they had forgotten. So don't put that in your paper. I don't like it. I don't necessarily count off on it, but if you put it in your paper, I'll completely ignore it. So what do we look at when it comes to liquidity, trends, and cash from operations? That's actually the first thing that is on my list on the rubric. Trends in net working capital requirement. That's the second thing on my list. We're not going to talk about the use and structure of debt, but I do bring that up. If you see your firm using a lot of short-term debt all of a sudden, you should ask. Sources of liquidity, we won't talk about this because you don't really have good access to this information. It's somewhat inside information. At UTSA, we met once a quarter, every 3 months with the CEO, where we actually went through in detail all of our sources of liquidity. We tested them. We made sure we could access them in a nanosecond. That's important, but that tends to be inside information. Another one is any potential liquidity shocks, like a major lawsuit or something along those lines. The only time you might be interested in this with your company, and you might put this in paper 3, is if your company has one huge major customer. So if you're Lockheed or one of the aerospace companies and you have a major customer, maybe it's the US military, maybe it's American Airlines or Delta or something like that, you probably need to talk about that one major customer because that could be a liquidity shock. I know the firm Cisco Foods, there was a time where 10% of the revenue came from one customer. That's pretty material. That's pretty important. I'm not asking you to do that, but at least for it, does this firm have one major supplier or one major customer that if some reason they canceled business with that company, they'd be in a lot more to hurt. And the last thing we're going to do is talk about free cash flow. And I'm going to show you this pictorially. I have a blog that you can read on free cash flow. I've been somewhat keeping it from you, not pushing you on it. Hopefully you've read it. But if not, I'm going to walk you through it with a good blog because it goes through all the issues. But we'll talk about free cash flow and what that means. So any questions at this point, because I'm going to flip over to Walmart and I want you to have your company open. All right, so everybody should have your company open. Anybody not have their company open? Y'all need to fly over and get your company opened and from the Excel. Someone last week was like, they didn't know where the Excel files were, so make sure you know where it is. I'm going to open it for Walmart. Last week I showed you the wrong Walmart. It was a few months old, so I got the updated one here. This is the one that I wrote the paper from. So you want this Walmart Excel open, and you also want, and this is going to be sort of part of the pain, is I got to flip back and forth between that and the Walmart write-up. If I can find it, where is it? All right, I got it open. Boy, I wish I could see what I'm seeing because it's just so frustrating. It doesn't. Anybody know why I can't? I got to go down the. Okay, sorry. Boy, I have too many files open. All right. So what you need to have open is this Walmart file on Word. Okay. Everybody find that? And you need your company's Excel open. You don't want the Walmart Excel open. You want the Excel open for your company. Okay. Anybody not there yet? Should have two files open. Got a thumb up from Victor. That's good. I don't know how to do the thumbs up. Someone's going to show me how to do that. All right. Let me walk you through a little bit of this Walmart files. So you have two main pages that you're going to use, print page 1 and print page 2. Print page 1, you're actually going to copy and paste as the last page of your paper 4. You're going to clean it up. You're only going to go down through line 51, though. You're not going to do the bottom part of this. I'll talk about the bottom part a little later. You'll clean up a little bit of it. I'll show you the places you might have to clean up the data. So what I'm going to do is I'm going to print page 1. I'm going to highlight the lines you need for liquidity. So let's pick a color for liquidity. Let's make liquidity blue. So line 12, lines 31 and 32, and lines 18, 19, and 20, those are all going to be part of our liquidity. All right. So the first thing I ask you on the rubric, if I could skip over to the rubric, the first thing I ask is just look at the firm's cash from operations and just ask, is it growing? All right. So here's the CAGR. If you look at the formula for the CAGR, it's just ending value divided by beginning value raised to the 1 over n minus 1. So in this case, I have 10 years. When you have 10 years, you raise it to the 1 over 9. Because when you have 10 years, you only have 9 growth periods. All right. Some of y'all might need to know this because you may not want to have your first year be your first year, because the first year might be 2010, 2011 coming out of the recession. So if you want to change it, instead of doing 10 years, you do a growth rate off of 7 years. This is the formula you'd have to change. You have to change it in 2 places, but that's the formula you change. Make sure you know how to do a CAGR. CAGRs are really, really important. It's known as the compound annual growth rate. So let's look at cash from operations, and Walmart's cash from operations have grown at a rate of 0.74%. All right, I need to actually get the inflation number. So I'll get this. I need to get it from other class anyway. One benchmark that you can use is what has inflation been the last 10 years? Because you expect your firm at a minimum just to keep up with inflation. So if inflation was 1.5%, 2%, then that 0.74% is a pretty pathetic number. All right, so I'll get y'all that number and I'll get it to my other class as well. But I always forget the point. It's going to be a little strange, the CPI, because y'all all have different periods of time depending on when your fiscal year ends. But I'll just do it from like March of this year back 10 years or something, just in general. It probably wouldn't be radically different if I switched it a month or two. So inflation is a good number. Another number you could think about is economic growth. How much has the economy grown? Because you think a firm would grow about the same speed as the economy as well. But obviously, Walmart's growth in cash from operations is pretty weak. Now, what's a strong number? Anything over 5% is pretty decent in this market. If it's a tech company, you might need to be over 10%. Somewhat depends. One thing you can do is you can compare it to your comparison company. So a few pages back, it says competitor. And if you look at Costco, their cash from operation has actually grown 11% a year. Some of y'all are doing Costco, so you'll have the 11%. 11% is a very strong growth rate. No question. So the 0.74 is very weak. So that's the first thing in the paper. So if I go back to the paper, I know there's some way you can use Alt something to switch back and forth better. But if I go back to the paper, look at the first thing I do. First, Walmart's cash from operations has been growing at a very subdued pace of 0.74%. And here's my chart. All right, now remember how I said I wanted you to do this. Let me do this for Walmart so you can just see it. So page 2, print page 2, you have that first chart. You want to change the title, but what I want to do is I want to add a new sheet right next to this. And as I use a chart, I want to copy it, don't cut it, copy it and paste it to this new sheet. And I'm going to edit this page. So one thing I'm going to do is I'm going to change the y-axis. I'm going to change the y-axis and maybe start it at 20 billion. I like to get rid of white space. So I'm going to change the axis. And the other thing I'm going to do is I'm going to put a title up there. Anemic CFO growth. So how do you pick your title? So the way I've been taught, and I think this is a great way to do it your whole career, the first title on your chart should say why you put the chart in the paper. What are you telling your boss? So I want my boss to see that the overall CFO growth on this company has been anemic. The second line should tell you what the chart is showing you, cash from operations. Now I probably should have said dollars and millions. Or thousands, yeah, millions. So that's 34 billion. So I probably should have done that. I didn't do that. So, check on that. Make sure you have that. You know, millions and billions, right? M is 1,000. MM is a million. Is that the way y'all were taught it? I don't know why M is for thousands, but I know in Spanish, M, it starts with 1,000. So maybe it's a Latin word. All right. So that's in millions. But everybody understand that your chart title should say what you're trying to tell your boss. Now, if you don't like the chart title like that, the other thing you can do is do a text box. And you could like put an arrow to 2011, an arrow to 2020 and say anemic CFO growth. And you could do it as a text box instead, your choice. I like it in the title. The argument you're having for this is don't make your boss stare at the graph trying to figure out why you put the graph in the paper. Let her know up front you put the graph in the paper to show you how weak their growth has been. All right. Questions on that? That's pretty critical. That you get this started from the very beginning. So here I got CFO growth volatile with anemic long-term growth. Here I didn't even say what it was because it just says CFO. I should have said this was CFO. So it's not. This isn't a perfect chart. The other thing you want to make sure you do, and y'all probably know this better than I do, but just to make sure when you copy the graph from Excel, make sure you paste it, paste special. And I always use a bitmap or use snip or whatever. but don't paste it as a Microsoft Excel chart object, because it messes everything up. It really does. You get, and see, then it's taking forever. I don't know. It just blew up the whole system. Look at that. Isn't that crazy? Just messed everything up. So don't do that. Paste it as a bitmap, especially when you get in these colorful charts. If you don't paste these as a bitmap, Bill Gates will change all your colors and all your margins. He messes everything up. He's sitting there waiting for you to do something so he can mess you up. So use a bitmap or use a snip. All right. So questions on just the process. You see what we're doing? We just did the very first one. Really easy. You have the growth in your cash from operations. Is that a weak number, a strong number? Okay. The one word I do not like that I see all the time is steady. Walmart's cash from operation has had steady growth. I don't know what steady means. To me, steady means it's not very volatile. But steady doesn't tell me anything. Find a word. Don't everybody use the word anemic. So try to avoid the word anemic. I mean, if you're growing Costco at 11%, anemic is not the right word. So strong, reasonable growth, acceptable growth. I don't know what acceptable exactly means, but I can kind of guess what you mean. You know. So the second thing we're going to do is look at the net working capital requirement. All right. So this is maybe the hardest thing in the paper. So let's look back at Walmart, and here I'm going to go to print page 1. I'm going to go down to lines 31 and 32. So look at your company on lines 31 and 32. Let me just make sure you're taking really good notes here. At least 25% of the class completely, totally misses this. All right, the net working capital requirement for Walmart is $17,208,000, and it's a negative number. Make sure you know that a negative number on net working capital requirement means that their operating cycle is a source of cash. So if C31 is a negative number, your operating cycle is actually negative days. You actually get cash before you spend cash. So your operating cycle is a source of cash. That's wonderful for liquidity. All right. A lot of students get stuck with column B. That's the CAGR. The fact that column B is positive or negative has nothing to do with whether or not your net working capital is a source or a use. That's just telling you to grow. Here it is. If you don't get this in your notes, you'll miss it. And I count off a lot on this on paper 4. If C31 is a negative number, so it's a source, you would like for that CAGR to be as high as possible. If your operating cycle produces cash, you'd like for that to be growing as fast as possible. You want yourself to be getting more and more liquid. And there's a close tie between this and profitability. So if a firm is getting its working capital requirement more and more negative, they're probably also getting much more profitable. All right. If your net working capital requirement is a positive number, so I just changed Walmart, that means it's a use of cash. In that case, you want this growth rate to be as low as possible. In this case, negative growth would be wonderful. All right, everybody see that? If your working capital requirement in C31 is a positive number, you want a low growth rate, even negative. If it's a positive number, I mean, if it's a source, it's a negative number, you want that to be as high of a growth rate as possible. All right, let me type that out for you so you can see it. I don't know if y'all are all following this closely. So let me type it in here. If C, what was that line? Someone tell me real quick. 51 or 30? Let me look.
C31. C31.
31. All right. So if line C31 is negative, you want a high positive CAGR in D31. Why? Because the operating cycle is a source of cash. The net working capital ratio is negative and is a source of cash. So if it's a source of cash, man, let it grow as fast as possible. That's great. And then it's the exact opposite. If C31 is greater than 0, in that case, you want a low or even negative CAGR in B31 because operating cycle is a use of cash. Net working capital requirement is positive. And the use of cash. All right, has anyone seen anything strange with your company? Let me know, but this is what we're looking for here, all right? I know even saying this as clearly as I'm trying to say it, students going to miss it because you got to go against everything your accounting professor said. I know some of y'all, these accounting professors, man, they always speak truth, but here's one area where they don't, in a finance opinion. Questions on that? Yeah, got it? All right. So let's look at Walmart. So looking at net working requirement, we see working capital assets are less than liabilities, which means net working capital requirement is a source of cash. The normal situation is that it's a use. So Walmart, that's really good. Strong liquidity management. We can also see that the trend in net working requirement has been improving with a CAGR of 6.7%. It's grown from, and what I do is I take the net working capital requirement, I do a percentage of cash from operations. And we can see that it's grown to 68%. Now here on this chart too, lower is better. So you can see for Walmart, their net working capital used to be only 18, it was a source, but it was only 18% of CFO. Now it's about the best number they've ever had at 68% of CFO. That's tremendous. This line going down means your firm is getting more and more liquid. All right. I know it's
Professor.
Uh-huh.
And that's for line 32, right? We're looking
line
at
32 is what I'm graphing, right?
Okay.
In this paragraph here, I'm talking about line 31, but here in the 6.7% is coming from line 31, but the graph and the 68%, the 18%, that's line.
¿Estás viendo lo de Trump ahorita? ¿Estás viendo lo del presidente y Biden? No.
All right, someone's mic is on.
¿Dónde está? Creo que Univision.
Tranquilo, por favor.
Hey, Professor. So if net working capital requirement as a percent, or line 32 is negative,
yeah,
would you want it to be negative if your line 31 is positive?
Now the only time, and that shouldn't happen, when you get something really bizarre is if CFO is negative. And I think I caught that, but if your firm's cash from operation is negative, you need to completely ignore line 32 and not use it. Or you leave it one year. So which company is yours? Is this Allen?
Yes, this is CarMax.
Do they have CFO that's negative? Their line
their line 32 is negative, yes, sir.
No, not line 32, but their line 12.
No, their line 31 is positive, so they seem to be using more.
Well, what's your line 12? Is it negative ever?
It was negative up until 2019.
Yeah, so a good point. I'm glad that you asked that, Alan. If your line 12 is negative, you cannot use line 32. You'll just have to talk to the numbers. Because then you're dividing a positive number by a negative number, and it's negative not because their net working capital is a source, but because their CFO is negative. So if anyone has a line 12 that is negative, if you just have 1 year that's negative, you can just ignore that 1 year and take it out. Just don't even show that point on the graph. But if you have multiple lines that are negative, Alan, you'll just have to not use chart 2, and you'll just have to talk the numbers on line 31. So if line 31 and C31, Alan, if that number is a positive number, then it is a use of cash for your company. And you just can't talk line 32 at all. You'll just have to talk about the growth rate.
And that's only if it's negative, correct? Or a positive, right?
If C31 is a positive number, it's a use of cash. His problem was that his line 31 was positive, but his line 32 was negative. The only way that can happen is if CFO is negative. Their net working capital is negative, but their net working capital divided by CFO is positive. These two should have the same sign. If they don't, there's something wrong with your CFO, and you can't use line 32. Yeah, that's a great question. So if you have positive CFO for most years, if not all years, so that shouldn't be a problem for too many companies. But Alan, you may be the one exception there. So I'm literally telling you, I don't even know what page I'm sharing with y'all now. So let me go back and reshare for this. So Alan, I'm actually telling you, just don't use chart 2 at all. Don't talk to 68 and 18%. Just talk the growth rate and the actual numbers. Alan, what you could do in chart 2, you could just graph line 31 if you wanted to.
Okay.
By itself. Now, line 31 can be positive and negative depending on the different years. So you can go up from being a source to a use, source and use. Anyone doing Disney, you'll notice that Disney flips back and forth. There are firms that flip back and forth. Lululemon, I think, is a firm that flips back and forth. Lululemon, I forget who's doing Lululemon. I think if you do Lululemon, I think if I remember correctly, I may be confusing it with another firm, but Lululemon is a firm that they have this line and it just hugs a 0. In a case like that, I would just say they manage their net working capital so well that it almost just disappears as an issue. They're almost always right around 0%. So if that's not Lululemon, it's another firm that just, it's just right around the line. All right. Now the question is, why is this happening? Why is their liquidity improving? And so if you go back to the Excel, I can't remember, it's Alt something you picked that I can jump back and forth back and forth. So if you go back here, at the bottom of print page 1, starting line 58, I've got a detail of all the line items in your working capital accounts. And what you can do here is try to figure out if something is going on. So remember with Walmart, their working capital was at its worst in 2014, but since then it's done a lot better. So 2014, so I'm going to change my CAGR. I'm going to do it from 2014. So 2014 is column I. So I'm going to make these column I instead of column L. And column I is it's 1, 2, 3, 4, 5, 6, 7 years. So I changed the 9 to 6. You got 7 years, you make it 6. So I'm going to do my CAGR from 2014. And what do we notice here? Look how much incredible improvement there is from 2014. It went from $4 billion source to $17 billion source. And why? Well, their accounts receivable actually fell during that time. I don't know what accounts receivable Walmart has. My guess is it's all Visa and MasterCard, but I'm not sure about that. They're doing more groceries now, so that may have some impact. The inventories haven't grown at all. That's really impressive, right? You got a firm whose revenues have grown $40 billion. Their revenues grew $40 billion, and their inventories didn't grow at all. How do you do that? That's really impressive. Their other assets hardly grew at all. Their accounts payable grew 4%. That's really good, right? That's you borrowing money at 0%. And their others. So why is that the case? Well, it's because they've really managed their inventories extremely well. Even with the high growth in sales, their inventories did not grow. They're doing a great job managing their inventories, but they continue treating their vendors the same way. So even though they didn't buy as much inventory, they did a lot more just in time. They kept paying their vendors really slowly.
Hey,
and I'm pretty amazed at accounts payable because my guess is they're buying more produce from farmers. You would think a farmer would want to be paid pretty quickly, but maybe they're really evil people in what they're doing, but it's working well for liquidity. I'm sorry, someone had a question?
Yeah, for the inventory, since it's been going negative, does that just mean that they've had a higher turnover ratio?
Yeah, higher turnover, it would be exactly that. I actually gave you the turnover ratio. If you look at Bloomberg PACE values, at the very, very, very bottom of that first section, line 48 and line 49, I give you an inventory turnover and an accounts receivable turnover. And you can see with Walmart, their inventory turn has gone from 8.06 all the way up to 8.9. It's improved dramatically. And their accounts receivable turnover is improved as well. So you definitely see it in the numbers. So yeah, they're doing a great job. We can even look at Costco. Costco's inventory turn has actually deteriorated. They've gotten worse, So Walmart's doing a better job of managing inventory than a Costco. Now Costco's might be partly that they've gotten in the bigger ticket items. And so that could be part of it. It's not that their inventory turn is slower, but that their inventory is more expensive because they're selling more expensive items. So there may be a good reason for it, but it still means it's making them less liquid. If they're buying flat screen TVs to sell, that's definitely going to hurt their inventory turn. So just anytime you see the word turnover, higher is always better. Yeah, anytime you see the word turnover, you just want it to be higher. All right, so Walmart's doing a great job here. So I'm going to talk about, man, they're becoming more liquid. No question, they're doing a great job here. You would expect Lululemon to have a really high net working capital requirement because of all their inventory. You would think that would be a really material liquidity crunch number. If it really is right around zero, it means they have something that should be a liquidity killer, and somehow they've managed it down to zero. Be really, really impressive. I don't know. We'll have to see the Lululemon people and see. I can look real quick and see if I'm getting my firms mixed up. But, you know, you'd rather it be a source like Walmart, no question, but it's really hard for an apparel firm to have net working capital requirement be a source.
Would that be because of like really high margins?
No, it's not the margins. No, it's really going to be how they manage. Yeah, Lululemon, it's gotten as high as 60%, but this last year, it's gotten almost back down to zero. And it was a zero a few years. So it actually got kind of high up to 60%, but it's now they've managed it down almost back down to zero. I think it was Disney I was thinking about as well, that theirs flips back and forth, but it's a really small number. So, you know, to me, having it close to zero, I'd rather be negative like Walmart. But if I'm an apparel store, a firm that really uses a lot of inventory, having that thing close to zero, I'm like, that's about as good as you can get unless you're Walmart and you have all that power over your suppliers. So yeah, I like that. All right, so I'm showing you the Word document again, right? Y'all can see the word here. So I added a paragraph after this just to talk about it here. I didn't do what I did in 2014. I should have done that. I went already back to 2010. But just show that the growth in inventories was less than the growth in accounts payable, and that's the reason this line's coming back. But I like what I just did there and explain why it's dropped so much since 2014. And that's because their inventories have not grown at all, even though their revenues have grown $40 billion. The receivables have actually shrunk during that time, and yet their accounts payable keeps growing at 4% a year. That's why they're getting more and more liquid. All right, there's the second thing on the list. So we got 2 of the 3. And that tends to be the hardest thing. That's where most students lose points on this, on paper 4 is on this part. It is a very different way of thinking for a lot of students. I think we're way too sloppy in how we teach this liquidity undergrad. All right, I'm moving. Someone stops me here. I'd like to get through this third one. This last one has to do with free cash flow. All right, so I want to show y'all something on free cash flow because it's really important that you understand the free cash flow concept. I can't remember how much we talked about it last class, but just to remind you, what is free cash flow? Free cash flow is when firm produces cash flow where they have their freedom to pay dividends, buy back stock, pay down debt, hold it in cash, or expand capacity. So what we're going to do in this section, we're going to look at 4 of these. In this section, we're going to look and see if there's any evidence that this firm is producing healthy free cash flows by seeing if they're paying a lot of money to their stockholders, or paying back debt, or if they're reinvesting in the firm. If they're doing these 4 things, they've got free cash flow. Now you got to be careful with the combinations. They might be reinvesting in the firm, but they may be doing that by borrowing a lot of money. That doesn't give you evidence of free cash flow. If they reinvest $10 billion in the firm, but they got to borrow $10 billion to do it, they're not reinvesting in the firm with free cash flow. They're reinvesting in the firm by borrowing money. But if they reinvest $10 billion in the firm and pay dividends and buy back stock and pay down their debt, they must be producing tremendously strong positive free cash flows. All right. Oh, did y'all see that? Was I not showing? Did I share it? Oh. Y'all didn't even see that. Y'all got to stop me when I do that. I don't know how that didn't happen. All right. Can y'all see this now?
Yes.
All right. So we want to see if your firm's doing that. So you've got one chart that shows you this, number 1, 2, and 3. That's the next chart. You're looking to see if you're above the line, then it's these things. If you're below the line, exact opposite. If you're below the line, you're borrowing money. If you're below the line, you're issuing stock. You're not buying back stock. The dividends can't be below the line. And then we're gonna have another chart where we look at expanding capacity. And then we'll have another chart related to acquiring another firm. All right. So you got 3 charts that are looking to see if your firm provides evidence of free cash flow. So let me share you with Walmart. So the first thing we do is chart 3. We look at Walmart, and we notice Walmart with the red has been buying their stock back every year. They've been paying really healthy dividends. They were borrowing money the first few years, then they started paying back. This green is paying back debt. Then you see something unusual in 2019. They borrowed a lot of money. If you see a line like this on yours, it usually means they did an acquisition. And sure enough, Walmart bought Flipkart in 2019, and that's why they borrowed all that money. So that's okay. That's usually okay. If they're borrowing money or issuing stock because they have a major acquisition, that's usually an okay explanation. It doesn't mean that they're illiquid. It just means that they had a major transaction to fund. But then in 2020, they went back to paying down some debt. So I look at this, and what we're looking here is to see, is Walmart producing free cash flow? And my answer is probably yes, because they're consistently paying $10 to $20 billion out to their stockholders and bondholders. You don't pay $15 billion out to your stock and bondholders if you've got a liquidity problem, if you're not producing strong free cash flows. And this firm definitely is. Now, it looks a little weaker than a couple of years ago, because a couple of years ago they were, 2017 and 18, they were sending $20 billion out the door. And now it's only 15, but it's still very, very strong. So that's what you're talking about here. That's evidence of a couple of things. It's evidence that liquidity is not a problem and that they're producing strong free cash flows. And the other thing it's evidence of is management's confidence in liquidity. Management has inside information on the firm, and they're not going to send out $15 billion outside of the firm if they've got a serious liquidity problem. So that's what you want to talk about. So what I'm going to say with Walmart, I didn't mention the free cash flow here. I should have. I'll talk about it further down. But there's evidence they're producing free cash flow. But one question you could ask is, are they paying all this money because they're producing free cash flow? Or are they doing it because they don't have anything to reinvest in the firm? So the next thing I'll look at is their CapEx, their capital expenditures, the CFO. And you can notice that has been declining for Walmart. So part of this in 2017-18, these large cash flows are probably because of healthy free cash flows. But part of this is because they stopped reinvesting in the firm. For Walmart, they stopped building new stores, which is hard to believe because they still keep building a lot of stores, but not as much as they were in the past. So, and then the last one is acquisitions. Some of your firms don't do acquisitions. And if they don't do acquisitions, I would just leave chart 4B out. Or if they've only done one big acquisition, just talk to that. But I just want to show with Walmart, they had a large increase here. And that was to do Flipkart that you don't see on this chart. So when you add acquisitions and CapEx together, you can see the large acquisition for Flipkart. But they did that with debt. They didn't use free cash flow. All right. So there's liquidity. So most students struggle the most with liquidity. Unfortunately, it's the first thing you talk about. So most students start off frustrated because it's the hardest part, and then it gets a lot easier. In fact, solvency is maybe the easiest part of the whole thing. So any questions on liquidity? Look at your company, see if you see anything really wild going on. Because I could pull your company up and look at it. What I recommend you do, you're working on paper 3. I'd recommend you do a skeleton of your paper 4 on liquidity as soon as you can after this class while it's fresh on your mind. It doesn't take that much time. I actually do this template as an exam in my 30th class, and students usually finish it within 2 hours. So that's the entire thing, including liquidity. So you should be able to get a pretty good draft of liquidity in like 25, 30 minutes. So if you did it right now while it's fresh on your mind, just set aside 30 minutes, get a good draft. You can go back and clean it up later. Then you can ask me questions next class. So if you can set aside 30 minutes, maybe tomorrow evening or something, and just get a good draft of liquidity done, I think it will really help your mental state in getting paper 4. You can almost get paper 4 done before, when we finish the class. You'll already have it done and ready to go. All right. So I'm not hearing any questions on liquidity. Let's jump in solvency real quickly because the first one's really easy. All right, so on solvency, there's 3 things. Oh, let me go. I'm sorry. Let me go to the class notes on solvency. Solvency is pretty straightforward, very straightforward. Oops, went too far. So with solvency, there's really 2 questions we're looking for. The first one is, can they afford their debt? Do they have the capacity to repay debts? So I'm on page 20 of the class notes, or somewhere around 20. So the first ratio, I do not like this ratio, but this is one Ryan, I was talking about Dr. Demedaran, some of the things that he does. He loves this ratio. He uses it all the time. I'm not a big fan of it, but it's times interest earned. Higher is better. The higher it is, the better. And I'll just give you a rule of thumb. If you're above 10, you're in good shape. So if your firm is above 10, just say no problems. They can handle paying their debt. It doesn't look like. So what we're looking at is how much income they have before they pay their interest. Compare that to their interest expense to make sure their interest expense is not going to kick them into a negative earnings. That's all it's asking. It's kind of a strange ratio. But above 10 is great. Between 2 and 10 is kind of okay, but not great. 2 or lower, you're in a lot of trouble. That's the danger zone. And the nice thing about this ratio is that 2 and below, 2 to 10, above 10, that works for just about every industry. It doesn't work for financial services, but it works for every industry but financial services. All right. That's the first one. Very straightforward. The second one is not your ability to repay the debt, but to see if you have too much debt, your amount of debt. And you were probably taught debt to equity. Debt to equity is becoming pretty unpopular in finance. And the favorite one today is debt to EBITDA. Almost everyone, I know at UTSA, we switched to debt to EBITDA everywhere. No one was using debt to equity. And if you think about it, this is the way you think about it when you buy a house. I seriously doubt when you buy a house, they look at how much mortgage you want to buy and they compare that to your net worth. Because a lot of people don't have any net worth. They'd never sell a house if they did that. I bet what they do is they take their mortgage and they compare it to your annual income. They say, oh, you want a $1.2 million mortgage and you make $22,000 a year? We don't think so. That's not going to work. Or you want to borrow $100,000, you make $125,000 a year? Yeah, we can handle that. So debt to earnings is the way we traditionally think about this anyway. All right. So that's what you want to do. You want to do 2 things there. You want to look at the debt to EBITDA, and then you just want to look at the pure just growth in debt. Those are the 3 things to do there on solvency. Really straightforward. I'll show you Walmart real quickly, just so you can see how simple and straight it is. So the first thing I do is times interest earned. It's well above 10, so not an issue. And there's the chart. And that's all I say. It's well above 10. Even if your firm is declining, if it's still above 10, just say it's strong. All right, that one's easy. At the EBITDA, showed it. I use the industry chart, so you'll notice you have an industry chart on this one. I compare it to industry. I might actually, if I do the chart, I might actually kick out the 0.9 line because it kind of distorting the line. Well, what I notice is that Walmart is right in line with the industry until 2020. Why? Because that's when they borrowed the money for Flipkart. So it kicked them above the industry, but it doesn't look too serious, but it's something to keep an eye on. And now look at the growth in debt. And the growth in debt was somewhat high, mainly because they borrowed that money for Flipkart. So there could be some other things going on there, but so that's it for solvency. Solvency is really straightforward. It's 3 things. Let's see if I can find our so remember on liquidity, we did CFO growth, net working capital requirement, finance cash flows. I really should call this, I should change this. This is the free cash flow assessment, but it's those finance cash flows, stockholders, bondholder. And then on solvency is times interest earned, debt to EBITDA, and growth in debt, those 3. So what we'll do on Thursday, we'll finish up the last couple of things on quality of earnings and short-term real quick things. And then we'll probably finish, might be able to get through the rest of it We'll see, because I do want to try to get into forecasting next week if we can. All right, any questions on anything? I can't stay over very late tonight because I got to get to my 9 o'clock class. So any quick questions? So I encourage you tomorrow night, do a 30-minute real quick liquidity on your company. Get it set up, even if it's messy, just at least get the draft in, get the charts in, so that you at least thinking about it. What people do is they look at B31 to determine if it's a source or use. So you don't look at B31 to see if it's anything. It just tells you whether it's growing or falling. But C31 tells you whether it's a source or a use. This recording out there probably hopefully by tomorrow. All right, good night, everybody.